spike trade, also known as, the spike striker. Basically, when there's a spike of volume, then we're looking to strike and actually take some premium out of the market, usually using Nadex Binaries. This could be used in other things. You can test that out. We've designed it specifically for trading on Nadex Binaries. Okay, and then we're also going to be adding in the this new strategy I'm going to teach you today. So I'm going to go over both of them to make sure you understand the first one and the second one. I just want to make sure you get them. So first, let's just go to what you have access to right now, and then I'll go back and show you how you'll also be able to apply it here in the next week with the new release that's coming out literally here in a week. And I'm going to go over, and I'm just going to open up, say the we'll do it. We'll do an oil chart over here. So let's do oil. Actually, you know what? I'll do US yen, because actually this is the harder thing to do, so I want to teach you how to do it on the more difficult way. So I'm going to go to US yen. We're going to click new. Now, this is a very important piece. Since the US yen is a spot Forex, okay, we need to get real volume, not fake tick volume. Whenever you see volume on a Forex chart, you're actually seeing just tick volume. How many times did it tick in that bar? And a lot of times it can be similar, but you want the most accurate one you can get. So you're also going to want to add, if you don't have it, okay, you need to add in your instrument manager the yen futures. And we show you how to get access to that for free on our website. So let me show you where that's at. I just want to walk you through each step, okay? So the A, B, C, and D. So step one, obviously, click here to get free access. Then once you're logged in, go to the member login area, log in. Then either activate your elite trial. There's a link right here to activate that, or sign up for, P3. Signals, there's a, link over here for that as well. Okay. So one of those two ways, and then just download the toolkit. We're going to add the toolkit in a few places once we make this release, but right now the toolkit's under step 2, and just scroll down here where it says link to download Ninja, link to download toolkit. Those are the two links you want. Now here are the videos on how to set stuff up, but those are the two main links that you want. And it's really simple. You just download Ninja and install it. Get your data feeds set up. Okay? So we have, 2 links right here. Like get free futures data, get free Forex data. So even if you're a P3 member, you can come over here to the Elite, step 2, for downloading Ninja, downloading the toolkit, getting your data feed set up. Don't try to install the toolkit until you have opened Ninja and connected data. Once you've opened Ninja and connected data, and then closed it, then install the toolkit. If you do it first, you're going to get an error. Okay, so you need basically Ninja to go through like a cycle of opening first. And so again, step 1, download Ninja. Step 2, get your futures data. Step 3, get your free Forex data. Step 4, after you've set all that up, okay, which literally takes maybe 10 minutes, and that's about 8 minutes of waiting, okay, like you're waiting on an email to come in. So once you've done that, then install the toolkit. Okay. Now, if you get an error installing the toolkit, there's 2 errors that come up that are probably most often occurring. One of them is if you have a expired futures contract, like maybe you have like CL 1214 or something, that'll cause an error in Ninja. If you have that error, just go up to our help desk right here and submit a ticket. We'll give you the exact instructions on how to do that, and I'll also post those over in the forum. But if you have that issue, just go over here, and we'll reply back with a step-by-step on how to resolve that, okay? The other error that people have is they may have like an antivirus software like Norton or McAfee or, whatever. It's an executable file. And so what a lot of those will do, depending upon how sensitive the settings are, is they literally will just quarantine a good chunk of executable files. And so what will happen is when you click on the toolkit to install it, you could disable your firewall, at least while you're just installing it. But 2, the other option is just really pay attention to the bottom right corner, because it'll give you like this little McAfee or Norton like warning. And if you click on that, it'll pop up, and it'll say, files being quarantined, Apex Toolkit, or whatever. And you just gotta say, don't quarantine it, like release it, let it go, don't quarantine it. If you don't click that, then you're gonna get this file cannot be loaded, contact system administrator error. Okay, like, and it just, like, no matter what you do, no matter how much you uninstall Ninja in the toolkit and reinstall it, it won't work because that software has permanently quarantined it. The way to solve that is go to your add remove programs and remove the toolkit. So go to like start, remove, just type in remove like in search, and then find the ApexInvesting toolkit and remove it. Then download it again and reinstall it, but this time make sure to enable it. If you will do that, then it will go through with no problem. Okay? So the third error people have is they try to install on too many computers, and it'll say too many computers. The fourth error is they try to install on another Apex account on accident. Maybe they forgot their old login, and it won't let you do that. It knows that you've used it. So you can only use it on that. If you need an extension on something like that, on the toolkit, whatever, let us know. But just in the help desk. But it won't let you install it on multiple accounts. So those are the four main errors. Again, if you don't know what to do, if you're lost, if you forget what I just said or how to do it, just go to the help desk. We'll be happy to help you and tell you how to resolve it. Okay? So these are just little common things that will drive you nuts if you don't know about it. And you'll sit there for an hour trying to figure it out, and we can tell you in 30 seconds how to fix it. Okay? So, use the help desk for any tech support issues. I've even seen people posting tech support issues in the forum and people reply with the answer. So it's pretty cool. But, and then of course for any trading questions, trading question forum. And we're organizing right now. We already have step one of basically 3 steps, and step 1 was the biggest one. Of what we're about to do on the forum. We're about to have a whole video plug-in, and I've been talking about it for months, but I've actually seen it now. And you'll be able to go in and click on things and organize things. You'll be able to say, hey, I've watched this, I want to watch it again, that was a favorite, that type of thing. If it's updated, it'll tell you, hey, there's an updated video here, and it'll actually put everything in order by topic. So you'll be able to go, like, I want to look at the binary videos, and it'll have every binary video by topic and description, and what, whether you've watched it or not, and all the little icons there, like watched, rewatch, favorite, updated. And it'll also have like a sort of a learning path. So if you're like, I want to learn this strategy, there'll be another thing that's like basically learning paths where you can go down those paths and it'll walk you through. These are the things you need to know. Because there's 100 things you could know, but these are the 10 things you need to know to do this strategy. You don't have to learn everything about Ninja or everything about Nadex, but you need to know this much. And so it'll take you through what you have to know to be able to execute the strategy, to make it a lot faster and easier for you to get up to speed. So we're always trying to improve and add things and taking in suggestions. And, we have traders helping out, and I appreciate all the traders that are helping out. One of the other things is we just added to our calendar, and by the way, sorry about the little webinar link error there. Go to webinar change to something on the recurring. We used to use one link, and now they've made it a unique link for every webinar. So we're going in right now, and by the end of the day, we'll have our webinars updated for like the next 3 months with all the right links. But sorry about that confusion. If you go over here to the event calendar, the news calendar, news trading plan, okay? Then on the news trading plan, you'll see one of the things we just added, and I want to give total props to Esteban. I worked with him on this, and we came up with, hey, here are the list of the stocks that are weighted that we need to be looking at, and went over the resources on how to get the information, and now we've added earnings to the calendar. So the major earnings, the ones that have like bigger impacts, at least heavily weighted on the Nasdaq and the Dow, are in here. What about the small cap and the S&P? Well, the small cap has 2,000 stocks, okay? One stock alone usually is not going to move it that much. S&P has 500 big cap stocks. Usually one is not going to move it that much. The Dow only has 30. The Nasdaq only has 100, but there's only about 20 of those that have any, not even that, probably like 10 that really have any massive impact on it, okay? So we put that in there, and it's not necessarily like a straddle or strangle plan. It's more of a be aware. Okay, you might be able to straddle or strangle it, depending upon which one it is. You might be able to do a butterfly, like right into it. But what I've learned is you don't want to go in, and I've made the mistake of maybe doing like a premium collection trade. I'm like, oh my gosh, I cannot believe I'm getting, for, $65 and 8 points away on the Nasdaq with only 10 minutes to go. I mean, I'm getting $35 a premium, and this thing's 8 points away. Oh, why did that happen? Because Microsoft has their earnings coming out at 4:10. That's why there was so much premium built in. Okay, and then bam, slammed. You know, so part of it's just to save you from getting the crap kicked out of you as a trader, to know when things are coming out. That's one of the number one uses of the news calendar, is just knowing when things are going to happen. Even if you're not trading the news, you better know. This is news that you should know is coming out. Like, you have no excuse if you're trading oil to not know the oil inventory report comes out at 10:30 every week. So expect some crazy volatility at 10:30 every week on Wednesday on oil. And so it basically is there to help you to know, hey, be aware of these events. If you want to straddle or strangle these events, fine, cool. If you don't, just know they're going to happen. And the market's going to explode on some of these when it does. But if more than anything, it's just a big reminder. So, but yeah, I got... Michael just said he's actually added pop-up reminders on his own calendar, so it'll pop up and remind him when those things happen. And this is different, by the way, on the earnings calendars than what you're going to see on earnings websites when you go to them. Like if you go to earnings.com or Yahoo Finance, the times you see are not going to match up. The reason is because we are posting the wire release time. Okay, this is basically based on when they release their wire. Like Intel usually releases its wire at 4:15. They may have their press conference at 4:30, but this is when the information hits the market and the thing starts flying. Now, it may fly again from the press conference later and after hours, but this is when, right here, the news report is expected to come out. Now, sometimes it comes out a minute early. Usually it doesn't come out early. More often than not, it may come out a few minutes late. Okay? Now, one time, I think we had Google this last year. It came out like at 1 o'clock in the afternoon. And Google got it was bad news. Google got hammered. And they didn't have a press conference for like 5 hours to be able to deal with it. I mean, it was horrible. I was really bummed on that because I love the Google trade. But we do that over the P3 room and even in the Elite room. A lot of times we'll talk about it too. And I even did the last one I did on air on TFNN, and that one just knocked it out of the park. So, but there's a lot of different trades you can do on them. But more than anything, just please be aware of these as a trader, just so you don't get killed. Okay, the bus is coming. Don't look both ways before you cross the street. And then if you want to add in and learn about the new stuff, check it out. Watch my radio show. I go over the news a lot on my radio show. And just the last few days, I've been going into straddles and how to know if a straddle is even one you should take. Like, okay, I have the ranges there, but based on the cost, based on where my take profit is, should I take this trade? I go into binaries, and I go into, well, which one's better, a straddle or a strangle? And the example I looked at yesterday, we actually found that I was risking more or the same money for no additional edge on the binaries, which is a bad idea because binaries are win or lose. Straddle, you can break even pretty easy. And so I walked through that in the last week. I went through a lot of detail, but every day I cover them shortly. But you can access that under the radio show archives. It's live from 12 to 1 Central, 1 to 2 Eastern. And then there's also archive links. So this will show archives from the last, 10 or 20 shows. Okay? And I am working with Mark Skelton on actually grabbing a bunch of those and flagging them and highlighting them with topics and all that stuff. He's actually been going through, he's been amazing help. He's going through and watched the last year. And he's getting all the ones and going, okay, which ones? Because some of them, I'm sort of just going through general market information. Other ones I'm really teaching. So he's going to try to find all those ones where I'm really teaching so we can start archiving those more. But you can always check that out. And sometimes I even do some live trades on them. But anyways, so take advantage of these little pieces and they will add up for you. Okay? All right, so the next thing let's get into is talking about the strategy. So that's where I was trying to sort of start out there. And once you've installed Ninja, you've installed you got your futures, you got your Forex data connected, you have installed the toolkit, okay? Then make sure you add to your instrument manager because a lot of you won't have this. Obviously you need to add the spot pair. Also add the futures pair. Okay, so it's 6J. If you don't know what it is, 6J, I click it, and there it is, 314. Now, the new version is going to actually pull all of this data for you from the futures and automatically assign it to Forex. So you won't have to do all these extra steps. But right now you have to do them. But give us a week or so, and you won't have to do this. Okay, like the indicator I have already does it, but it's not automated. There's still a manual piece in it, so we're making sure it's all automated before we release it. Make sure you go over there to 6J and add it. If you don't know what the future contract is, simple tip for you. Okay, go over to the scanner. This is probably one of the easiest ways. Just go to the spread scanner, and once it loads up, then you'll be able to go down, select whatever instrument you want, so like pound, euro, whatever, and what it'll do is it'll actually tell you what the future symbol is. Okay, let's see, do I have it here? Yeah, see, 6B. Okay, another place to see this, I don't know if we have just a calendar under Nadex calendar. Okay, this another piece that's important. So just to make sure you understood that, on the spread scanner, when you select the currency, if there is a currency that would be useful, you can see it. But just a review for you, I mean, you got 6A, 6E, 6B, okay? So A is Aussie, E is Euro, B is British Pound, okay? You got 6J for US Yen. You have 6C for US CAD. And you have 6S for the franc. Those are your main FX pairs. So call your G6. And the other way to find them is you can go to cmegroup.com. You can go to Products and Trading and FX. And you can literally click, these are the featured, but you can say, show me everything. And it'll load up every FX pair, which can get sort of confusing because you're going to see options and Euro FX. Euro FX is not the same thing as Euro dollar. Okay? So, I mean, it is the same thing as Euro dollar. Yeah, make that real confusing. I mean, they got peso, they got all sorts of stuff. Now, whether or not your data feed includes it could be a different story. But you can go down, you can find all the symbols right here built in. The micros, the fulls. You want to use the full-size contracts for volume. You could use the micros to trade if you wanted to. But you want to use the full size for volume. Also, in your instrument manager, you could literally just go in and type in, pound, and see what comes up. There you go, 6B, British pound. Okay? So, but you got to type in the right word, So, but I mean, if you did British, that would work. But I mean, on the other side, you could type, the thing is, if you type in GBP, you're not going to see it. So, but on description, if you type in pound, or if you go to, if you typed in like sterling, then you wouldn't see it. Because a nickname for it is sterling, so that's just to use British pound. But anyway, so that's some of the different ways to see it. But I just want to show you a few different ways to find the futures contracts if you don't know how to. All right, let's see here. Now, what I'm about to go through with you is also covered over in our forum as far as how to set this up, because you're probably going to forget. But I'm going to go through it again and right with you. But just go to news, go to deviations, and then go to deviation level trading system. Okay, I'm going to teach you two systems. There's only one on here. But what's important on here that I want you to notice, and this is a little bit of an update to that as well. So this is actually a little more updated than that. But is that it'll go through and it'll actually provide, let's see, he provided in here somewhere. Where is the link? I thought we added a link for the template. Oh, it's probably one of the next pages. Probably we can add that to the first page. And anyway, so you go through, and I'm showing like different ways to set it up. We've actually made it simpler than what you're seeing right here, so you'll like this when I show you this to you. Here we go. Okay, here's the template. So on page 2 of that, you click right here. It says zip file. It says download and save. Open the zip, and then you just click on it to open it, and then grab the file. Like just grab it and drag it. Okay, and put it in your documents, Literature 7 templates charts folder. Okay, so that's one template. You don't have to do this template because we're about to show an even easier way than this template. And we're always trying to improve it. We'll add stuff on. We can even get a new template up, but either way, you're going to need to walk through these steps for now. Okay, so now let's go ahead and walk through them. File, new, chart. And then we're going to choose US yen. Now I'm also going to go down and I'm going to add 6J, okay, which is the yen futures for real volume. I'm going to add that 3 times. Okay. I'm going to make my US yen minute based, 5 minutes, and I'm going to make sure on all of them I choose default 24/7. Okay? So right here, default 24/7. Things in my pocket. All right. And let's see. Got that one. And then we'll also make this one minutes and 5. Okay, we'll go down to this one right here. We're going to make it minutes and 10. And then we're going to go down to this one right here. And we're going to make it minutes and 15. Okay? So it all depends upon what your default settings are, whether or not you need to go through all that. And then we'll go down to default 24/7. So we can just make sure all of them are default 24/7. See, I missed one. Because it can sort of throw things off if there is some other setting in there. Okay. Now, if you were doing this on the Dow, or basically on a future, okay, Dow, oil, gold, whatever, I'm going to teach you on the yen today. But if you're going to do it on the others, you would just add the Dow 3 times. You would have to add it 4, okay? Oil, add it 3 times, okay? So that's all you need to do, 5, 10, and 15 minute. So now the other thing I'm going to do is I'm going to make the other ones, and this is also, so I'd make the other 3 if I'm adding the futures to the Forex pair, or I'd make the 10 and 15 if I'm just adding the future. Transparent. Okay? Otherwise, I'm going to have like all these charts just filling up my screen. So right here. And then right here. The only one I'm leaving where I can see it is that first 5 minute one. Okay, now that I've done all that, I'm not using any templates right now, okay? Just clicking OK. So now you can see I have all this information here, sort of useless, okay? Now we're going to go into the indicators. And what we're going to do is we're going to add the volume spike indicator 3 times. So 1, 2, and 3. And then on each one, we're now going to assign it to the chart we want it to be on. So I want this to be on the 6J close, okay? 5 minute chart. So hopefully everybody saw that there. Now it says calculate on bar close, okay? Say leave that to true, because for this to really work, you want this to be I want to wait for the bar to close to calculate it. I'm going to go over here, and I'm going to assign this to the 6J 10 minute chart. Okay? And I'll assign this one to the 6J 15 minute chart. Now something else you'll notice is these are what are called panels. Like panel 1, panel 2 with the 5 minute, panel 3, panel 4. So I don't have to take up a lot of space. I'm going to stick this on that actual panel. And so you can say same as input series. I believe that will work. If it didn't, then you could just literally say panel 2, panel 3, and panel 4. Okay, now you're done. All right, so we're going to click OK. So that'll show me like when volume spikes happen. To make sure I can actually see the volume, so that gives me the volume spike, we can now throw the volume on. So we'll go down here. You can either use VOL or you can use volume up down. Either one. Volume up down, just if it's an up bar, it's a green volume bar. If it's a down bar, it's a red volume bar. Doesn't really affect the strategy. So let's go ahead and add all three of these as well. Right here. And one more time. Go through the same thing. And let's change it. This is, I mean, it's a little bit of a process. Now, the nice thing is, I'll show you the futures, and it's faster because you can flip charts. The Forex is a little bit of a pain because you have to set it up. If it rolls, you got to go in and basically start over. If you want to do a new Forex contract, you got to start over. Okay. On the futures, you can just flip from chart to chart to chart. But let's set it up. But if it works and it makes money, I don't care if it takes me 5 minutes to set the chart up. And then once you save it, just save the thing. You don't have to do this over and over and over forever. And again, we're about to automate this whole process for you. Okay. So it'll be really, really easy. But you want it now, so I'm showing you how to get it now. Okay, and then also we're going to do the same thing. Now notice this is saying new panel. Okay, so we're going to make this, 2. Now you could also say same as input, but I'm just trying to help you out here. 3, and then 4. Okay, and then hit apply. Now I have the volume bars, and I got the diamonds right there. Okay? When there's an alert, let's see here, we'll have the alerts that will pop up basically every time there's a volume. And I'll show you some of the new features we're adding in a minute, but for this strategy, you're going to want to see both. To see the alerts, to see them now, historically, whatever, if they're popping up, go to Tools, or sorry, File, New, and then Alerts. And it'll pop up all your alerts. Okay? Have all those also, like volume spike, 5-minute volume spike on. And it'll tell you what contract it's on and whether it's a 5-minute or 10-minute or 15-minute. So, we have a lot of cool stuff coming for you. But it'll pop up and tell you that there was a volume spike. You will need to, you may have to reset your alerts occasionally. Okay? So just so it'll pop up when there's a new one, that makes it a lot easier to notice, because if the screen's full and something pops on there, the screen really may not look that different to you. Okay? So that is literally how to set up the chart. That's the cleanest, easiest way. Now, you don't necessarily need to see all this volume. You know what you care about? Those little diamonds at the bottom. Okay, so these little yellow diamonds, that's what you're concerned with. Right there. Okay? One thing is to, let's say, like, you don't like the open high low close, you want candles, whatever your preference is, you can just click that and change those up. Okay. So this is showing you what a volume spike is. You can see whether it's on 5 or 10 or 15 or all three. And a summary of a volume spike is basically a volume bar with that's twice the amount of volume on either side. Okay? Nothing that fantastic, but how to trade it is what's unique, and to automate it, because it's so easy to not even see it or think you see it. Like right here, it looks like it's volume spike, but it's really not, and you don't know unless you go in and measure it. But we did finally get one here on the 10-minute bar. Okay? So now let's talk about how to trade a volume spike itself. Now that we have the chart set up so we can see it, and what will happen is you'll be able to open the chart up in the future and just pull up US yen. And when I say future, I mean like within a week. And it'll just literally throw them right there, 5, 10, 15. You won't have to do any of these steps. You'll have one indicator, and it'll throw them all up on the screen for you. Okay? So let me add one other indicator I like to add on, which is just the drawing tool. Where is it? The toolbar. Okay? Makes it easier for me to point to things so you can see it. And here's what we're using for a traditional volume spike reversal trade. Okay? We look for a few things. But for the traditional one, we add in one more step. The new one, you don't care about this new step. Okay? But the traditional one, the premium collection one, you want one last piece. And you want deviation levels. Okay? So that's right, Rodrigo. Good. So now the new one, you won't need that. But the traditional one, you do need it. And so let's add in now, and we want these on our US yen. Okay? So let's add in actually 2 indicators. And we're even making an upgrade to the deviation level indicator. But you can click, so Apex Diagnostic Deviation Levels. You have access to this as a P3 member or an Elite member. Okay? And Apex Diagnostic Deviation. Click New on that. And click Apply. Okay, again, you don't really care about these volume bars, you just care about the diamonds, so feel free to shrink it all down. Okay? And what we're really looking for on these reversal trades are 1 deviation high to low moves with a volume spike. Okay? Or 1 deviation moves, period. So when I say high to low, there's 2 things we're looking at. Okay, 1, it could just be a move from settlement to +1, settlement to -1, or a 1 deviation from the high to the low. To help you easily take care of that, I mean, you could manually track it with the ruler, but to easily take care of that, that's what this deviation indicator is for. The blue line is how far it's moved. The orange line is an actual deviation. So if the blue line gets right up there to that orange line, you know it's moved a deviation. And think about it. If it's moved +5 up, then from the top to the bottom, okay, so from up here to down here is a deviation. If we measure a deviation, these are implied volatility deviations, by the way, if you're new. They're not based on standard deviation, they're actually derived from implied volatility, which means the pricing built into options on how far the market actually thinks the market's going to move, not pricing based on how far the market has moved historically. All right. So once we go in there, we have that. Are we at a deviation level? So is your first question. Have we moved a deviation from high to low? So I'm gonna, yeah, there we go. Okay, gotta get some participation here. Excellent. So, yeah, we're at a deviation high to low. How do you know that? What's the easiest way? Right here. There's deviation indicator right here. Now, you could measure it, but it just tells you right there on the screen. And let's see, got one other question coming up. Right there. Okay? So now if we've moved a deviation high to low, did we get a V spike? We get a volume spike. So yeah, how do you know that? Because there's a big diamond right there on it. Okay? All right, respond. All right. If you want to, Darby. Okay, so I got 2 questions that came up just now. And one of them was, why is implied deviation better than standard deviation? Standard deviation is based on historical volatility. It's basically how far has the market moved up and down, therefore how far will it move down. Well, think about every single disclaimer you ever read. Past performance is not indicative of future performance. And so why in the world would standard deviation work? One of the things Bernanke was quoted for saying whenever the 2008 crash happened, was he literally said the model is broken, and he doesn't, it's just broken. What was the model he was talking about? The model he was talking about was the standard deviation bell curve. Okay? And It's basically how far the market's expected to move based on how far it has moved historically. And it was breaking all those records. I mean, we were getting like 300-400 point swings in the Dow, and that wasn't an odd occurrence. There was just some crazy nut stuff happening. So that model not only has it always been broken, but it was definitely then it was definitely broken. But the model that never breaks, okay? I mean, you could say it can have a transition of breaking, but it fixes itself very fast, is implied volatility. Implied volatility is if I'm going to buy something, okay? And I'm going to buy insurance, which is basically what a call or a put is. It's insurance on if you buy a call, you're insuring a short stock. If you buy a put, you're insuring a short stock. I mean, you could just be going short, but the purpose of it is a hedge. Okay, that's the original reason it was made. If I'm going to do that, then there's going to be a premium associated with that because somebody on the other side is taking risk, right? So if I buy, I'm just using call and put example. If I bought a call for $3, I have unlimited upside, okay, and I can only lose $3. Well, somebody's going to take that unlimited downside, because if I have an unlimited upside, they have an unlimited downside. Now, they could be hedging it out. They could be doing a vertical. They could have the stock to deliver, whatever. But if somebody's going to take that, they're also going to charge a premium for how much they think it's going to move. And you'll actually see implied volatility go up, like on stocks like right before an earnings announcement comes out. Like right now, Intel, their implied volatility is about as high as it gets, okay? It'll get really high right before earnings, and it'll make all of the actual options themselves more expensive whenever that happens. And so, since that implied volatility goes up, the options get more expensive, and it will cause there to be there's basically an expected larger move. So, if the market expects, and think of this as a survey. I'm trying to figure out the best way to phrase this. Think of this as a survey. We'll get to your question in a minute, Rodrigo. Think of this as a survey where people have to put their money where their mouth is to place a vote. Okay? It's not, do you think the market will move 10 points today? Yeah, I think it'll move 10 points. I think it'll move 4. I think it'll move 6. No, like when they buy an option, when these hedge funds and fund managers and banks and investors and retail investors, when all combined buy or sell an option, they're saying, I believe it is worth this because I believe this is how far it will move. Okay? And so you can actually take that. There's a whole complicated formula for extracting implied volatility out, and then use that number and go, okay, this is how far the market says the market's going to, not has, but going to move. And then we take that number, and if it says the market's going to move 67 points, 67 ticks today, or whatever it is, and we post them on the website, but they're also auto-plotted if you use the indicator, which makes it a lot easier than trying to manually plot it. Like right here in the scanner. We have them, I'll show it to you here. So on like the yen today, said the expectation on the bell curve, not the expectation based on past, but the expectation based on current market pricing, is 67 pips. Okay? And now, that's basically a 70% of the time we don't expect the market to end higher or lower than 67 pips of where it closed yesterday. That just happens to be 67. It could be 15, it could be 114, it could be all sorts of things. But on US yen, it's 67. And this number can sometimes greatly fluctuate. A lot of times you'll see it stay the same, but then it'll go up huge. I remember when we had the S&P, it was down at 8 points a day. And then it went up to 17, and now it's down to about 14 right now on expectation of movement. So this tells us how far the market expects the market to move, and that gives us a big edge of if that's as far as the market is expected to move. Now it may move double that or triple that. That's what it's called, a 2 and 3 deviation. And there's only 96% chance it'll move greater than 2. There's only a 4% chance it'll move greater than 2. There's only a 0.3% chance it'll move greater than 3 by the end of the day. So it may bump up above it, but actually stay up above it. Very, very, very small chance. Using that information, if we think that at least 70% of the time it's going to stay, within this 1 deviation range, then when it hits that, we expect it to move down 1 deviation, which it has moved down a deviation, and probably bounce. But what I found is sometimes it does go 2 or 3, right? I mean, remember that's 2 and 3. We have 1.5, 2, and 3 for a reason plotted on the screen. And also, I mean, they're actually on here. So we got those for a reason, because it does happen. So I need some sort of confirmation the market's going to go the other way. Okay? And now, when this happens, the market doesn't necessarily just bounce and reverse. Sometimes it does. But often it'll just pull back some. Or it'll just go choppy or flat. Okay? It doesn't necessarily just like run down a deviation and then fly up. So this is sort of the market is exhausted. This was the expectation. It's moved as far as all the big money has said it was going to move. Okay? So it gives you a huge edge in your trading. I don't care if you're trading Nadex or not. If you're using this, it will make you a better trader, period. Okay, if you're trading spot, if you're trading CFDs, if you're trading futures, if you're trading binaries, spreads, forwards, we can go down the list of contracts. It will make you a better trader. So that's the whole idea. Is this is the expected movement. It went down here, and then we have a volume spike. And one of the questions posted was a full deviation, a half deviation won't do. You can try it at a half deviation. But if you want the highest probability trade, okay, you want a full deviation. So go in and do it, see what happens, see how it works out for you. It may work out great, but I just found for consistency purposes, I prefer them at 1 deviation, high to low or greater. Now we're at a minus 0.5 deviation, but remember we moved a full deviation from high to low. So since we don't necessarily know if this thing's going to bounce back up or go flat, just oscillate a little bit, what it's going to do. And by the way, the bigger the time frame, probably the more the bounce. So if it's like 5, 10, and 15, you're probably going to get a stronger bounce, okay? So that's an additional clue that I haven't really talked about before. 5 minute may pull back a little bit and then sort of oscillate back over. 5, 10, 15, a lot of times it's like, bam, and it'll fly back the other way. And I'm not saying all day, I'm just period of time. So how do we take advantage of this? Well, what you do is you go over and you go, okay, well, on Nadex, let's see here, let me pull up. I can find this screen. I've been logging in and out like 400 times today. Alright, let me just open simple. Since I don't know how far it's going to move, then what I want to do is I actually want to collect premium. Okay, I don't have an expectation of movement on this specific trade. We're going to talk about how to have an expectation on another trade here in just a second. But since I don't have a specific expectation, then I'm going to collect premium on it. And the way I collect premium is I buy under the low. So let's look at where that would be. So now this is the low of this bar. There are a few that are a couple ticks lower. See, like right there, 104.14 versus the low of this is 104.18. Honestly, I prefer to get, if I can get, the 14, I prefer it. But at least the low of, like right there, that part of that V spike, the bar surrounding the V spike. Okay? So that pops out. Remember, that's a 5-10 minute bar. Okay, so these two bars, that's 10 minutes. So they actually closed right there, and then this bar happened, and now we're looking for a break. What do I mean by that? If the 5 minute bar closed here, the 10 minute bar also closed here. Like this would be 10 minutes. These two bars. Okay? And then, which means these two bars will be the 10 minutes that, so when this thing popped up, was right when that bar closed. Alright? And you can sort of tell that, like right here. You'll see the little volume bar there on the 10 minutes. That helps out a little bit on understanding how it's working. So really what I'm doing is now I'm looking for I'm not going to pull up open, high, low, close right now because it's a little harder for everybody to see. Whenever I'm sharing the screen. I prefer open, high, low, close as a trader, but people then are like, I can't see your bars. So now what I want, knowing that, okay, this happened, 10-minute bar, 2 bars after. 15-minute bar would be 1, 2, 3 after, okay? 5-minute bar would be the first one after. And just to reiterate that, if I got a 5-minute V spike, this is bar 3, okay? If I got a 10-minute V spike, obviously they're 5-minute bars. That would be bar 3, okay? 5, 10 minutes. And if I got a 15-minute V spike, that would be bar 3. Okay? And what do I mean by bar 3? Well, if this was a 5-minute V spike, it basically takes 3 bars to make a V spike. It takes the bar before the big volume, it takes the big volume bar, and it takes the bar after the big volume bar. So I want bar 1, bar 2, and bar 3. When they complete, then I can get that diamond on the screen. Once I have that diamond on the screen, which is once bar 3 has completed, okay? So since it's a 10-minute one, 2 bars, then what I'm going to look for is a breakout of that bar's, in this case, since it's been moving down, a breakout of that bar's high within 3 bars. Okay? So we got 1, 2, did we break the high? So let's see, what is the high? The high is 104.32, the high of this bar, 104.30, the high of this bar, 104.35. So we literally just got a breakout of the high on the last 5-minute bar. It could happen. Now, you don't have to wait for the bar to close. Intra-bar, if it breaks the high of this right here, so right up here, if it breaks the high of this bar, and I'm just trying to make the bars even more visible for you. There we go. So see, there's a little bit of a let's see, which one is it that makes them? Okay, I'll do this to make the SMR so you have a little hard time seeing it. You can make the, this is, just so you can change your colors, your candles, whatever. We'll make this like 4 and 4. There we go. Okay, that's just going to make it really thick. Makes it really easy to see. So we're looking for a break of the high of this bar. We got that break right here. So now that we got the break of that highest bar, what we're looking for is an in-the-money binary contract that is ideally somewhere between, 104, what was that, 14, 104.18 and 104, I want to say 14. So 104.18 and 104.14. Okay? So we can go over to the binary scanner. And we can go up here at the top and we can choose US yen. And one of the things I've been teaching people and using the scanner, they get really lost, is don't try to figure out all your filters first. Go down here and figure out what you don't want. And then get rid of stuff. Okay, I have US 500 on here. Well, let me just uncheck that. I don't want US 500 right now. I just want the S&P. Okay? And I make I don't need the ones that expire like in more than 12 hours. I'm not interested in that. Okay, that'd be a big time frame. Let's go down here. Okay, I don't want all those. And I go, I'm doing premium collection, so I only want the in-the-money binaries. Okay, let's get a little tighter. Okay, and I might even stop there. I might even not add anymore. Okay, that might be sufficient. Just in-the-money binaries. Let me see what there is. And then I got to go over here and I go, okay, now let me find a binary. And I got 104.14 and I got 104.18. And let me see if I can find that strike at an acceptable price. And if I can't, I don't have a trade. And that's okay. Now understand, we're a little bit late to the game here. We should have been buying, a few ticks ago. So if I find the contract, we can go back and look at the chart. But we should have been buying literally 15 minutes ago right when it came over here and it broke this high of this bar right here. So we've lost 15 minutes of time, which doesn't sound like a lot, but could be huge in a binary. And we've also lost about 5 ticks, which can be literally 10 or 20 bucks in a binary. So first, let's just find a contract that I'm going to turn off the in the money filter for a second, just so I'm going to put this on. I do $5.95 all the time, by the way, just to get rid of those like $5 and the useless contracts, ones that are $3. But since we're going for a breakout over here of this bar of 104.32, and I want it to be down here 104.18 and 104.14. Really, I'm just trying to see, can I find a contract that is that low? Because I might not be able to find one. But can I find one that's that low? 104, there's a 104.15. Obviously, that's not a bad contract. And now let's see if would that have worked. Okay, so we got the noon 104.15s. And I can actually go over here. I can go to the binaries and go to US yen. Go to 12 o'clock. Go here to these 104.15s, and now I'm going to select the quick chart. Now, the only reason I'm doing this is because we missed the trade because I'm walking through it. Okay? But I just want to see, where was the price 15 minutes ago? And we'll get real specific on it so it can be accurate. So where was the price at 10:35? And probably say about 2/3 up on that bar. Okay? We go in here, we got, say 10:35. I see if these are plotting the same. Yeah, it's like Nadex, so on Nadex that'd be, you see where it says 10:40? My bars are plotting the close, their bars are plotting the open of the bar as the timestamp. So 10:35 on Ninja would be 10:30 on Nadex. So you can basically see where that thing broke the high. And so my low was 81, my high was 90.50, and about halfway in between the bar we got filled. So it would have been priced right at about 85 bucks. That'd still be pretty expensive, but that would be an example of a binary premium collection trade. So this one got triggered a little late, but that is an example of one of where you go in $85, it goes up, you take it off, but you'd be holding on to it, and you can look for the contracts. The hardest issue is just finding a good V spike, and sometimes they're great V spikes. Okay, when you got 104, I guarantee you that one was definitely at a good price. If we go to 1 o'clock, again, the longer you go though, the longer it has to come back against you, and the less time works for you. So you just want to be aware of that if you choose further out time frames. But that's the V-spike trade. That's all it is. It's pretty simple. When you get a spike, breaks out of it, then a few bars of the high, okay, of that V-spike there, then that's when you're looking to get in. Not the high, but of the third bar, bar 3. Okay, so now, what is the other trade? Because the other trade's actually in progress right now. So the other trade would actually be the opposite, it's sort of funny, of what we're doing at this very moment. So I'm just going to throw it on and then we'll talk about it. Man, come on. Okay. Okay, the other trade, the magnet price trade, is when a V-spike happens. Okay? What normally happens is the market will go flat or go up for a bit. And the bigger the V-spike, 5, 10, 15, the bigger it'll move. But then it comes back to that price over and over and over again. Okay? And so you have the premium collection trade running up if you catch it in time. You know, you grab 10, 20 bucks on it, in the pocket, in, out, done. Okay? But then you have and this is what you'll call the predictor magnet. Basically, you're having this expectation that it is going to turn back around, actually, and go back to that price. And this isn't just, I don't know how to put this correctly, but this basically isn't just some, like, magical thing. I hope it works. This literally is how the market works. Okay? And what happened was they were driving down the market all morning. And they started unloading shares. You can see where the volume started picking up. We didn't quite get a V spike, but you can see the volume like went really low. You know, they started buying some of their shares back, okay? Buying some of their contracts back, and it popped up a little bit. They laid off. And then they did a little, like one last like little sell pump just to try to really get the thing down. They did that, pump back up. They tried one more time to get rid of the rest of their contracts. Because when you do like, you know, 1 million or 100 million units of currency, it's a little hard to get rid of. So you got to do it in waves, which is, by the way, what causes the apex pattern. Okay? And it's those $100 million trades going off. And so this right here goes off, and then boom, this is the last one, and we know it because that's when the volume spike happens. It's like, okay, poof, done. Well, they're done selling into the market. Okay, they've been selling, they've been buying back, selling, buying back, selling, buying back. They're done selling, they bought back all their shares just now. And so the market pops up a little bit off of that because they bought back, and the market doesn't fall because there's no more sellers. The market falls because there's no more buyers. They back off, they're out of the way. Big boys are now going to go back into, if they get back in, an accumulation distribution mode. Okay? And so the market will oscillate back up, but then it'll basically just come, people are, okay, it came back down to that price, and they're going to look at it, and you know they're going to think, okay, it's going to come back down, and slowly it will trickle back down. It usually takes, on average, at least during the day, most of the trades take about 2 hours. Okay? I mean, I'd say actually between 30 minutes and an hour and a half, so like less than 2 hours to complete. And so the expectation is that will move back down to at least this price. Okay, the 104, you know, was it 18? If not even lower, potentially to 104.14. Okay? And so you could put that contract on, and then you set a take profit, and the most conservative method would simply be, if I sold it at 81, just put a buyback over here at, you know, 61.5. Just going for, you know, 20 bucks. Is it going to work every time? No. But what is your risk? Well, I have a $20 stop loss. You know why? Because I have a $20 risk on the trade. I don't ever have to get out of the trade. I don't have to take a stop at any point. Okay? Which is beautiful. And the next thing you can do is you could actually do 2 contracts instead of just 1. And the idea being here, if you do 2, let's say you're risking about, actually I risked about $16 on the trade total. So if we go in, I added 1 more in there. Give me 1 second. Where's this at? Alright. So if my risk was 100 minus the sold price, 84.25. My risk was 1575. Subtract that from where I sold. So 1575, 84.25 minus 15.75. So buy back at 68.50. So what I'm going to do now is I'm going to actually edit this order to buy back at 68.50. Okay? And now what happens if my first one takes profit? What risk do I have on the original position now? I mean, in reality, like how much risk do I have? So if I risk 16, wait, let's make it easy. If I risk 15 bucks and I do it on 2 contracts, so it's $30 of risk. And on the other trade, okay, and on one of them, not the other, on one of them, I take $15 profit. So 2 contracts, $15 risk each. And on one of them, I take a $15 profit. How much risk do I have from what I started with? Zero. Good job. Yeah, Steven, Michael, awesome. Zero. Okay? I started with $30 risk total because $15 times 2. I made $15 on one of the contracts. Okay? Since I made $15 on one of the contracts, the other contract only has a $15 risk. There's no more risk on that contract. In the sense, I mean, yeah, I could lose my $15 profit, but I've covered all the risk on that trade. Okay? I've eliminated I eliminated all my risk now. Now I can still end up taking this one off and grabbing it for $15 if I want to, or $20 if I want to. But sometimes when these things happen, they keep going and going and going. And I could just trail my stop. Okay? And if I mess up, the worst thing is I come out with everything that I started with. Now, obviously, that's as long as one of the two hits that profit. But it's... So I basically have like 3 methods, you know. And one method is conservative. And that's where I go in and just do, like, you know, whether I do 1 or 100, I get out of all of them at, you know, 1 to 1. Okay? Now, sometimes I can go for a lot more than 1 to 1. Because if this thing actually got down to 104.15, who can tell me what that binary is going to be worth? Yeah, $50 plus or minus, right? So, you know, bid-ask spread and all that fun stuff. So I can actually make more than 1 to 1 just by going for the strike itself. So that's like method 1. Just get out of all of it when it hits the strike or at 1 to 1, you know. The second method is, you know, do 2 of them and tier out. So remove all risk on one and then trail my stop. So now I have no risk, you know, initial capital risk in the trade. And the third one would be I'm trailing on everything. So now the fourth one, which is a little bit crazier, but it's pretty sweet when it cleans up, and it does clean up sometimes, is when I get this signal, I literally just knock out the book all the way down. So like I'm selling 1 for 8. You know, how can I put this? I need to get a deeper book so I can show you. The prices have moved since we started talking here. But it'd be like selling like 1 for 82. And then so I risked $20 on that, okay, and then risking 5. Like so, I'm selling like 5 of these for $94.50, and then like 5 of these for $96. It's only $4 risk on the trade. So I do 5 of them. So I'm doing $20 risk on each one, or I could say if I'm going to make $20 on the first one, then I'll put 2 on the one below that and 2 on the one below that. You know, or I may go, you know, those are only $1 difference, so screw it. If I do $20 on this one, I'll do another $20 on the one below it. So I do 1 of those, I do 5 of those. If I clean up on that, if just the first one hits, I can remove all the risk of the second one. And the second one, if it actually, you know, hits or expires, you know, if it hits, I make a killing on it. I mean, if I got out at 50, I'm making 40 times 5. Okay, so whatever that is, $200. It's an awesome profit for a, you know, max $40 risk total. And I eliminate $20 risk by getting out of the first one. And if I actually closed out 2 of those, make $100, okay, make $20 on the first one, I could leave the other 2 on. If they expire in the money, they're gonna, I mean, they really clean up. So that's what I call tiering my binaries, and you can make some massive cash tiering. That's actually how I usually play Google. So I'll do like the first one to eliminate my risk, as long as it hits, and then my second, third, and fourth layers, I'll just be like taking out the book all the way down. So it's a pretty cool way, some methods to, you know, think about when you're trading this. But you can see how this is moving, and if it does keep moving, you know, we got to get one of them filled. We still got to get one filled. We got to get filled in the next hour. If it fills, we've removed our risk, and now we can choose how we want to manage the profit on the remaining contract or contracts. 5 minute, they're going to move a little faster. 10 and 15, they still close. I was actually marking up yesterday's chart. Let's go over this with a few of the traders. Hold on a second here. I mean, these are basically, I do these triangles on here every time we had a V spike show up. And so I'd spike, drop down, came back. Okay? I mean, we had them going in both directions sometimes. Spike, went up, came down, spike up, went down, came up. I mean, back and forth. I mean, a couple of these, like, you know, obviously, like these right here were a couple hours. You know, these were, and I mean, you can't get in immediately. I mean, every once in a while you can get in right away. But most of the time, I mean, it's got to pull back some for you to even be able to get a decent fill. Okay, we have one happening on oil right now. Like right there, spikes, pulled up, coming on back down, right there. Okay, I mean that's a pretty nice move too. Now these are diagnostic bars, which makes it even cleaner. But and you're talking, if you're just using the break of the low here to be your trigger, once you can get a good fill on the price, they're 94.14 going for around, what's on the V spikes right here, you know, 93.64. So it'll actually be released before 3.0. So it won't just be 3.0, it'll actually be released before that. It'll be part of 3.0. So but it'll be re-released with it as well. But like we're actually going to send it out in the toolkit. But you don't have to wait on that. I mean, it's here. But I mean, you can see all these trades. I mean, boom, spike, comes back, spikes, and that's why I want you to release. I want you to see how often. I mean, it's pretty nuts. Okay, just over and over and over again. Market spiked, took its time, ran up, came back down, and I mean, it came like right back down to where that spike was. Okay, so there was some lower ones that happened right after it there, but after the pullback came right back down. It actually did still break it later, but right back down to where that spike was. It came up here. We got spikes. Market pulled back. You know, it took it some. That one took forever. Okay, now also notice this is like midnight. Okay, so don't be surprised when the trade at midnight takes a long time. Market barely moves. But by the market open, bam, thing is all the way back up. I mean, this is even at night. This isn't just during the day. Spikes down, pulls back, comes back down. Right there. Right here. Spikes down, pulls back, comes back down. This one spikes up, pulls down, comes back up. Right here, spikes up, pulls back, comes back up. Spikes down, pulls up, comes back down. Spikes up, comes down, pulls back up. Okay, I mean, just over and over. Spikes up, pulls down, comes back up. These are 5-minute bars, you know. Spikes up, pulls down, comes back up. Spikes up, pulls down, comes back up. You know, both in the same trade. Still going. Spikes up, pulls down, comes back up. Spikes up, pulls down, comes back up. Spikes down, pulls up, comes back down. So we were both directions on that one. We had a short one, we had a long one, and we even had an intermediate one, all at the same time. Yeah, so the first side of the triangle is where the spike was. The last side of the triangle is when it came back. I actually drew this one last night. I had the trade on. And then the peak of the triangle is basically just showing how it moved. You know, so it moved far enough to be able to get a fill. So, Steve, exactly. The first trade that I showed you was an in-the-money V-Spike premium collection. Because, I mean, think about it. I mean, it does... Now, also, it's also... The first trade is a premium collection, remember, at a deviation level. Okay? Which is an awesome trade. Works really well. Works often. Those of you who have been following those know that they're good trades. More often than not, they do really well. You're only going to get a couple a day. on a market. Now you can watch 10 markets, you can get plenty of signals. This right here, these are V-spikes anywhere during the day. So I don't care if it happens at settlement, at 2 points above it, at 5 points below it. I don't care where it is. Because I'm expecting a retrace on this. And the payout's a lot higher, so I'm not as careful. You know, when you got those preview collections, man, the payout can be low and the risk can be high. Yeah, this has nothing to do with the deviation level. The out of the money, the second one. The first one does. So it's working on it. It's still trying to, you know, come on back over there. Maybe it's back. It's still working on it, taking its time. But, and I mean, you know, the issue you're going to have in me, sometimes it's going to take longer than you got into the trade, okay? But as you start watching these and you see how long or how often they hit, let's say we come to noon, okay? We still have an hour. But let's say we get to noon and the thing doesn't come back and fill our first contracts take profit. That could happen, right? But let's say you see that most of these go back and fill. What might you decide to do? What might be a next decision? 12 o'clock passes and the binary expires out of the money. What would be a potential solution? No, not the stop ticket. It expired. So, let's just go with the assumption that they usually, like, 80-90% of the time, okay, at least, fill. I mean, you saw, like, that was a whole day yesterday. And I mean, I can pull this stuff on oil, gold, whatever. It doesn't matter what market I pull it up on. They fill, okay? But was the problem that the contract didn't move, or was the problem the contract didn't move fast enough and so my contract expired? It didn't move fast enough, yeah. So, if I still believe the trade has the potential to move that far, I've lost 20 bucks, and it sounds funny, feels a little awkward, okay? But again, big benefit of being in the money. Just do it again. Just put the same trade on. You know, grab a couple more hours, whatever. And if that one works, I mean, at least it covers the risk on the first one. Now, I wouldn't, like, keep going. I wouldn't go, like, 3, 4, 5 times, because, I mean, the thing could literally, you know, just, you know, it may just be one of those ones that just takes off and it takes 3 days to fill, okay? So I wouldn't just indefinitely do it. But one more time, adding on a few more hours, actually, to me, makes complete logical sense, because I expect most of them to fill. Every once in a while, it may take longer than expected. Now, and there's two preferences here. Okay, part of me prefers to get the longest amount of time I can get and get that 1-to-1. The second part of me says, man, I want to make a lot of money and get the cheapest one I can get as close as I can. Right? Because, you know, $10 for, you know, 2 hours from now, $20 for 4 hours from now, or whatever. But just think about the fact that, you know, it's going to be worth 50 when it hits the strike. That's a big benefit, okay? And the more time you have, the more time it gets to do its thing and make money. Yeah, the prop potential is, yeah, silly. Yeah, just by tiering it. Yep, you're right. I wanted to retrace to, really, technically, a retracement to 104.18 would be acceptable, because that's where the V-spike happened. I'd be surprised if it didn't get to 104.15, but since the V-spike happened over here at 104.18, that's where I would expect it to retrace back to. Let's see here. Why did you not sell the first one? Didn't you want to buy it? Yeah, so there's, okay, remember there's two trades happening. Okay? So if you can find the right contract, you can do the premium collection trade. It's pretty easy to find an out-of-the-money contract. Because it can be a little harder to find an in-the-money contract for the price you want. So, yeah, we did go here and we sold this when we expected to come back. Now, the cool thing is if you do premium collection, and let's say it takes some time, and so you went over here and you're like, okay, well, what can I get for a decent price, whatever. I mean, you could do the 104 at this point, which, I mean, seems a little nuts, but for $89.50, but I mean, you're collecting you only pay 16 down here. So there's a 104.20. That's too high. But there's a 104. I mean, that's below both of the strikes that we're looking at the market to get to. Now that's 3 o'clock in the day, so that's quite a bit later. We got 104.15. That's the one that we sold for 12. You look at 11 o'clock. Obviously, that's gone now. But I mean, yeah. So you definitely the retracement off the one deviation. Then you could actually do premium collection to help pay for your out of the money one. Your premium collection makes money as time's going by. Your out of the money sort of losing money as time goes by. But take profit on your premium collection one, and then market moves back in your favor. Awesome, and one may hedge off the other. It's a pretty cool. It's sort of almost. How do I put this? If I bought an in the money, and I sell an out of the money, I mean it's. I don't know. It's like some like. I don't know. Morphed strangle butterfly. Because you're sort of wanting both to happen. You're wanting it to go up and you're wanting it to go down. So, but I know there's a name for it. I can't think of it off the top of my head. And you can also you can fit your trading preference. Maybe you don't like premium collection. So this would be a way for you to, because the hardest problem about out of the money trades is you need to have a price to target. So this actually gives you a realistic price to target. The hard part about premium collection is you either need to use the stop ticket or you need to have good risk management yourself, manually sitting there, and you need to win a lot, especially if you don't. So this trade was me showing you the new version. I mean, I've taught the old version. You got that one down. So if you don't, go back and watch those videos. So the trade I actually put on here for you to see, which may or may not work. We don't know. But if it doesn't, we can still go back in and do it again after 12. And I encourage you, hop in again on your demo and knock this out. So this is actually the predictor magnet strategy. So. And basically, it's a magnet price. We're predicting it'll get to that price. Okay? The predictor has a lot of forms. A lot of people are thinking the predictor was just one strategy. It's like 6 strategies. So, the volume spike, they're both. Volume spike is what it is. It's a volume spike. Okay? It's not the strategy. It's just a volume spike, technically. So the strategy, we have the in the money one. I think Mark helped me come up with this one. Was Spike Striker. So on that one, on the in the money one. So, basically just spikes. And so that's why, he came up with the idea of putting even to help code the first run and put the little lightning bolts on there and everything. So that's the in the money one. So there's an in the money and an out of the money, both on the same concept, but just that oscillation back and forth. Okay, so let's see here. What about volume spikes in 5, 10, 15? These trades have a higher hit ratio. I would say they all have a great ratio. It's just a matter of how long they take to fill. Okay, let's see here. So yeah, you can definitely do the same thing with diagnostic bars. It's actually pretty sweet when you throw all this stuff on top of the diagnostic bars. So it starts filtering things out for you. It starts letting you know to take caution. Actually gives you confidence. Like let's say we get an apex and there's some volume spikes. What do I expect? I expect it to go back up. So yeah, I'll take that E. Okay. So things like that. So when those volume spikes happen, I expect that retry. Now I do expect it to pull back, so I'm not shocked that it's pulling back. Okay, that's that initial V spike, spike striker or premium collector. So I'm not shocked that it's pulling back. It's not freaking me out. But I also expect it to retrace, so I can't wait till I get the next D. So that's a cool benefit to it. And we have some other stuff too. We have the predictor line, we're going to use that to help filter out apexes, so that way if the market's just running against us. I think we had an example yesterday on gold. I was going through all these. Let's look at the hardest market to trade and see if this works. That's what that was part of our litmus test. It's like, it's always easy to find anything that works on an easy market. Let's find the hard stuff and see if it actually works. And we were like, holy crap. And but yeah, it was really, really cool. So we were going in and watching, and like right here at the predictor line. Now that's the time scalper. That's the little arrows you're seeing. Is time scalper. By the time scalper, the predictor line saying south is going down, so we don't take an apex entry, we don't take an apex long. We get a volume spike. That means we expect this thing on that down move right there. We expect it to move back down. It does move down. You get the apex retracement. And then right here, the E's above the power line, or not the predictor line. And so we're okay. Can't take the trade. And we're glad we didn't, because it only moved like 3 bars. And then another one, can't take the trade. It's above it. Oh, by the way, you have a volume spike. It's probably going to pull back up. It does. So we avoid all of this chop. All this right here was completely averted by just adding on the spike striker there and the time scalper and the predictor line. So some of the issues we've had with, basically, I mean, one of the hardest things as a trader is it's not too hard to come up with a trending strategy. It's not that hard to come up with an oscillation strategy. It's hard to figure out which one's happening when. And so, by adding in these pieces, what it's done is it's helped us filter out the chop on our, trending strategy. It may be a medium trend or whatever, but it's helped us filter that out. The arrows are the time scalper, Rodrigo. And there's a lot of ways to use them. You can see, you could sell and buy spreads. You could sell in the money binaries. You can do a lot of things. So obviously the ideal is going to be the combination of putting all the pieces together. What's cool is this wasn't even the intent. We were just going in and really trying to find us some good intraday binary focused strategies. And after back and forth, over and over again, and testing, back testing, live testing, forward testing on just every combination of what market, what time frame, what everything, can it, okay, the strategy works great on paper, can I actually get the fills? Just down the list. Then we found, hey, okay, this is working over here on binaries, and then we go back and we go, I was like, what would happen if I threw this on our diagnostic bars? What would happen if I threw this on the apex charts? Just curious. And I was like, oh wow, that filters out like a ton of bad stuff that I would not want to trade. So it's pretty pumped up. Question, I thought you didn't like volume on diagnostic bars. I don't. I notice I still don't have volume on my diagnostic bars. I'm looking at 5, 10, and 15 minute volume. This is actually pulling the 5, 10, and 15 minute volume bars while I'm looking at the diagnostic chart. Does that make sense, Danny? It's actually looking at the 5 and 10 and 15 minute bars. Yeah. So what's cool is we're basically by using the deviations, we're using implied volatility, which is live. By using the volume spikes, we're using volume, which is live. By using price, we're using, obviously, price. The diagnostic bars are built on price. The pattern is built on price, which is live. And then the velocity bars are speed, which is live. So by using all of that, we're actually able to, we're using four things that, and notice not indicator, like those four things right there are pure, just live pieces of trading. And rarely are time, speed, volume, speed, volume, implied volatility, and price action, those four pieces all combined together. So, but this is, if you've been wondering what's happening behind the scenes, why stuff is taking so long, is it worth it? This is it. So, didn't just want to throw something out there to throw something out there. I'm like, we really want to make this, and what I'm trying to do is remove the style as much as I can. And that's really my biggest goal, is how much style can we get rid of, so you can become just very, very, very systematic. And so every time we release a new improvement on Apex, like the elite strategy, the whole goal is how can I eliminate this whole style problem, because style is experience, and that takes time, and that's what I'm trying to. Obviously, the goal is to cut the learning curve down and expedite your ability to not only see it work, but also not have to spend 3 months learning how to read 5 different things. So yeah, styles important, and I've talked about it before. There's gut style, and there's systematic style, and there's system. So gut style, that's the thing when I say I only let this account for maybe 5 or 10% of my trades, when I do something, and usually it's to not take a trade. That's gut style. That's just things I've seen, okay? And that's long-term experience. That's, you feel the heartbeat of the market thing. It's one of those things that you should not ever make a majority of your trades on, because you'll be wrong. Systematic style is, news is coming out. I can't account for that in the programming, every news announcement that comes out. It's maybe it's something we haven't programmed yet, like choppy market warning being built in, or volume spikes, or whatever. But things that we see over and over and over and over again, that, deviation levels, turn it off, that type of thing, or at least watch it. It's things that we see over and over and over again that we're able to follow consistently. I'm able to see, and 20 other people are able to see. Like, if they're taught it once, they know it, and they're able to do it. That's systematic style. It's not playing by the seat of your pants. It's not really your opinion. It's what the chart is telling you that's happening, that either can't be or is not yet accounted for in the software. Okay, and then there's system, which is here are the rules. So you got to start with the rules, because you need somewhere to guide everything. But once you start with the official rules, then you need to learn how to read the markets a little bit. Okay. I'm not talking about just randomly reading, like, consistent things like volume, spikes, deviation levels. And that will help you in your trading. And then over time, you'll start to notice, as you spend hours in front of charts, whether that be over a couple hours a day, whether that be 8 hours a day, once you spend hours, like, you cannot, I can't even, there's no way to understand it unless you've done it, but the more hours you spend in front of a chart, the more patterns you start to notice. Like, when this happens, it seems that this and this and this happen. Is this just me seeing this, or, and that's sort of where the systematic style and gut style come from. So systematic style will be, I see it over and over and over again, and other people see it too. Gut style is just something I see. I can't even figure out how to explain it. I just notice it. I don't know how to say it out loud. I couldn't teach anybody how to do it. So, but yeah, it's pretty sweet. I mean, gold is one of the most difficult things to trade, and seeing all that come together is pretty cool. I mean, even this trade right here, I mean, it's a good trade, but it's just choppy. I mean, look, it goes down, boom, doesn't even hit the X yet, pulls back up. Now we got a volume spike, pulls back down. I mean, you'd be nervous, like it's probably going to pull back up again. Gold will probably pull back up here at least. I'm not saying that the Apex will lose, but you got a volume spike. Probability, it's going to pull back up here. So, But this stuff filtered it out. The next release of the toolkit will include... There's going to be 2 releases, ideally over the next week. The predictor line and the time scalper, those arrows, version A and B. There's two, they're like a red and a green, and there's a pink and a blue. And when that comes out, I'll do a training on it. I'll explain it. Those are the next 2 things that are coming out. And then when that comes out, right after that, then we'll be releasing the next day we'll be releasing the volume spikes, the new version. That will, and we actually have a couple of versions of that, because what we're probably going to do is have like a little bit different version for diagnostic bars, where you can put the 5, 10, and 15s, but filter them where they only show when there's a deviation. Okay, for your volume spike reversals. But then we'll have like a sort of like a circular logo or whatever. Be different colors, but it'll show just on the diagnostic bars at any time. And then it'll actually give an alert. You can actually tell it only alert me when it happens at this price. And we're also working on adding in this is why this was the second release. We're also adding in, you know how I told you had to count like 3 bars over and all that stuff? We had like block A, block B, block C. We're moving on over. Almost there. But the whole block A, block B, block C thing, where I was saying, okay, this is on 10-minute bars. Let's see here. Let's zoom in. This was block B. This is block like A. Because basically that's 10 minutes, 2 5-minute bars, and this is block, C. And basically having something like an arrow, like right there, and right there, to show you when it breaks this, boom, that's your buy signal. So now that's for like the 5, 10 minute, 15, deviation breakout, V spike. So it'll only show up when it hits it. And it'll actually show you at what price to, at least what level right there to look at. So that's what we're trying to accomplish. So you can see that's why the V spike is going to take a couple more days. But what are we going for over here? We're going for 68.50. So we need a few more bucks. We're getting down there. Not there yet. With the V-Spikes, will you be launching a new signal service with this? Yes. So, and we'll add, like, if you're a P3 member, you'll be getting access to it as well. Now we're gonna, we're figuring out how to put it all together. But the whole idea is actually we're gonna be tying this in, and so instead of you having to sit here and watch all these V-Spikes all day, have a couple of us, at least a market, if not a couple markets. I mean, there's only so many to keep up with through a signal service. If you're sitting in front of your computer, it's a lot easier. But actually coming out, being sent out like text message, on-screen notification, Twitter notification, all 3. So on your desktop, on your phone, and through Twitter. So, and we can do them day and night. Like I showed you earlier, they happen around the clock. And just trying to. I mean, this is just real trading, trying to get all the different pieces to fit. So one of the big pieces on here, I'll go back and look at a couple of these with you. Right here, we got a 5-minute on this bar, so you can see another one right there. So we got that one. One of the reasons we're starting with USDN is because, one, the strikes are only 5 ticks wide on the intradays. Makes it a little easier to find one. Yeah, we got filled. We already took profit. So now we control our stop, right? So you can see we're up. Now we're up at over 22 bucks, 30 bucks, 22 bucks. So on that trade and going. See, just sit back and let it do its thing. So the triangle on that one really was right here from the V spike. Okay. And then let's see here. I was trying to line it up. That one was so small, I mean, you couldn't do anything with it. But it was just like pull back. That same thing. That one went like the other way. They filled, but they were just tiny. Right here. And this is a big one. This is at night, like early in the morning. It's only a 5-minute one, and so you can see like that one looks like it didn't fill ever. So 5-minute one right there. The 5-minute one I really would expect to fill within a couple hours. So on that one right there, that would probably be a losing trade. So you can go through, you can find them, look at all of them. Line them all up. Let's see here, and I may be wrong. Let me double check it, but that might be. So I like the new one too. I like the new one a lot better. So we'll go over here. But yeah, so I mean you got, I mean these are like 3 a.m. if you're crazy and you want to trade that time of day. That one. Right here. Spikes. Up right there, pulls back. There, spikes up, pulls back, goes back up. Right here. Like 5, 10, 15. You gotta like across the board. But basically, there. And you just keep going. But you can see, I mean, we've only had like 1 or 2 of them that lost. So, not too shabby. So, I mean, you got to find the strike. It's got to move far enough. You know, all that fun stuff. But, you know, all in all, I've been really impressed with it. It's worked really well. And see this right here? Check this out. Look at, look at where it went to. And basically, like, I think to the tick or a tick lower than that low. Where it pulled back, you know, 104.14, 104.14 to the tick, the exact same low. So now you see why I want to take that one off at 1-to-1 if I want to try to go for more. I mean, it hit it. It's like a sort of like a gap trade, man. A lot of times it'll hit settlement and just bounce perfectly off of it. So if I want to go for the big bucks, okay. See, I was up like 25 on that second one. Now I'm only up 3. I'm like, I'm freaking out, especially if I'm holding on. So, by taking that first one off, I mean, I don't have any risk. If this loses, I come out the same as I started before. If I close it now, I'll keep my 15 bucks and the, 25 cents I'm up or down or whatever. So, and as it gets closer to expiration, you're going to have to make that decision, what do I want to do? But the trade, I mean, officially the trade is done. It filled. So the alternate things where I want to go for more money, that's optional. And I mean, you look at some of these, you get a V-spike right here, this thing goes down, and it's just, I mean, you cleaned up. So you just got to decide, is that worth it to you? And if it is, remember I told you there was like 4 methods I had. I have one where I just go in, I take profit, 1-to-1 or at the strike, Method 2, I put on a multiple of 2, take profit on 1 to cover half. Okay, so that way there's no risk remaining in from when I started with. My initial risk is gone. And then method 3, which I don't think is wise, but putting it on and then trying to trail your stop because it often will bounce off of it like that. And then method 4, which is put your first one on for 20 bucks, and then maybe instead of doing 2 of the same strike, maybe tier in your strikes so there's a big cleanup if there is a big move. And part of that I'm working on. Number 3 I don't like, so it's just I'm letting you know, sort of like these are all the things we've considered. What I am looking at is like at what time of day, and we haven't totally perfected and figured out yet, but I'm assuming it's going to be at night, like certain times at night and certain times in the like early morning is going to be, especially like on the open, would be more that time I'd be more likely to do the tiered program. Like right now we're going into lunch. How far down do I really expect the market to move during the lunch hour? Probably not that far. So tiering now, probably not the wisest idea. Maybe doing like 2 of them and trailing my stop, but not tiering. Not expecting it to move like 30 ticks down during lunch. Okay? And then also looking at a couple other realities. How far down have I moved so far? Where am I at? What am I sitting at right now on a high to low basis? Remember that's the reason we did the reversal trade to begin with? So we're at remember a 1 deviation high to low, right? So how far further down do I really expect the market to move? The whole point of the volume trade, remember when I said I would really want to, if I did the volume reversal, the V-spike trade, I'd really want it below that low right there. The whole point of that trade is we don't expect it to move down that far because we're at a 1 deviation level. So I'd be more likely to tier or trail up here in the middle, or if I got a long, than I would down at a 1 deviation level. Does that make sense? If I'm sort of at the expected move, I don't expect to move that much further. But here, I'm at settlement. I expect this puppy to move. Okay? I expect it to move at least, it's already moved up 30. So I expect it to move down at least 30, 34, because a deviation move is 64 pips. I expect it to come down at this half deviation line. That's where tiering, comes into play, when you have that expectation of movement. Are you limiting your risk to $20 when entering a magnet trade? I try to get it around $20. I mean, I've done 25. I've even done 30. So it sort of depends upon where it's at in relation, what time it is. So I'd say a ballpark, somewhere around 20, 25. Yes. But an absolute rule, you just got to look at what's available and what time and what expiration. And if I get another hour for $25, yeah, I'll take it. Like instead of 20 for an hour and a half, if I can get 4 hours for 25, hands down, I'll pay the extra $5. So will you send strikes if you do signals? Yeah, all of our signals, we always do that. We send market, direction, exact strike, exact expiration, exact price. So, or we say approximate price, because the market, may fluctuate by a couple bucks. Yeah, we always send entry and exit, strike, signal, price. The predictor line, is that different than the predictor signals? All this stuff is part of the predictor signals. So there's more than just one predictor trade. So like some of those predictor trades I've been sending out, Rob, this is part of that. It's not just one signal. So the predictor is based on pure price action. So to make it better, we've added in things like volume, implied volatility, time, stuff like that. Deviation levels, All right, cool. Well, that trade did work. So now whether it makes a whole lot more, we'll see. But again, we don't have a lot of expectation because we're at a 1 deviation level and it's lunchtime. Okay? So yeah, so if you're in both, I mean, you may want to take off both, you know. So I'm just, this is why I'm working through all this, as I'm working through it with y'all, is going through, you know, different pieces. Like, okay, we're at a deviation. You know, what do I expect? I don't expect the thing to just fly down. Yes, Danny, you can use it for nighttime also. So I bought it a bunch of them at night. Some of them are huge. I mean, this is right here, 630. Look at that. Going in. Got a quick one. Really, that one would have worked at night because they're so cheap. Right there. You got another spike going the other way. Where you had like two, like basically had a strangle going on right there. I mean, it just keeps going, going, going. So. Would you consider butterflying it? It was not really a butterfly trade. Remember, we're doing out of the money. So, I mean, you don't know. It's not like you're buying at the high or selling at the high or low. You don't know where the tip of this triangle is going to be. I just know I'm looking to basically sell for $20, maybe $25, or sorry, yeah, sell for 75, you know, or 80. We're going to buy at 20 or 25. I don't know. I mean, I may get filled here. I may get filled here. I may get filled here. I don't know where in this triangle I'm going to get filled for my $20 trade. So I wouldn't. It's not like you know, like this is the high and this is the low of the trade. So it's not so much of a butterfly trade. So you could butterfly to 1 deviation level. I mean, we've had a V spike. You had a deviation with a V spike. I mean, I could see the logic on that. So in the sense of, okay, expect it to pull back some. That's my regular volume spike trade on a deviation because of a V spike. But since I have a V spike, I do expect it to come back down. So, and then, yeah, add in the time of day. Exactly. Then you could look at it being, range bound and go, okay, this is my range. Because it's noon, because I had a V spike, put all those pieces together. That could make for a great butterfly trade. Yep.